I've been saying for a couple of years that we're at 5 minutes to midnight when it comes to the fiat system. A lot of people look at me like I'd gone mad and sort of scoff it off. But something has changed. Now people look at me and look at me like I've gone mad, but instead of saying, oh no, it's not going to happen, they say, Clive, you've gone mad. We're
Well,
2 minutes to midnight. Not 5 minutes to midnight, we're 2 minutes to midnight on the fiat system. So people have started to realize that the end is nigh and are starting to wake up. So we've gone from a situation where people say it's never going to happen to we're much closer than you think, Clive. So this reset, which we're all talking about, you hear it everywhere you go now. What is it? It's basically when something goes terribly wrong with the currency or with the bond market. I think it'll come from the bond market at the end of the day, and there's a panic situation. There's a rush by individuals to spend their money on anything. In other words, currency is going down at the expense of real assets. So real assets are melting up. They're going up very rapidly. Now, we don't know what will cause this. It could be some disaster. It could be some crisis, because you know how people act like lemmings. Suddenly they say there's going to be a shortage of sugar, and then immediately everyone rushes down to the shop and all the sugar bags are gone. So we don't know what would cause it, but if this happens, and it's just a possibility, we might find ourselves in a situation such as we found in early 1933, before they withdrew all the gold, when they closed the banks. In 1933, they closed the banks for a couple of weeks while they tried to sort things out, and then a month later, they ordered everybody to hand in their gold. But what would happen this time, I think it could be a situation where they close the banks to re-engineer a new type of system. And that might be a system based around gold, or it might be based around the central bank digital currency, or it might be a system based around a blockchain solution or tokenization. There could be many types of things out there. It could be a bail-in system where if you've got more than a certain amount, you're obliged to invest in government bonds to support the system. Or it could be simply, I think this is the preferred solution of governments, an acceleration of the rate of inflation. So what they would do is say to the central bank, we want you to stop interest rates rising because it's killing us. So we want you to cap the price of long-dated bonds by buying them in, and the central banks print money to buy in the long-dated bonds. So that's another type of reset. It's basically a sort of hyperinflation where you get rid of the old debt through high inflation. Obviously, this is a potential problem which is coming, and we don't know when it will happen, because there'll be no warning. But the moment you see it's definitely going to happen, there's a lot of things that you might want to buy which you won't be able to buy because there'll be nobody willing to sell it to you. The preferred solution at the moment is one of central bank buying government bonds, i.e. if the interest rate or the yield on longer dated bonds goes above a certain level, and I'm guessing perhaps it's 5.5% in the USA, maybe it's 6%, they will invite or coerce the Federal Reserve to step in and buy bonds either through the back door or directly, and that's their preferred solution. But there are other solutions out there. But let me just talk about if the Federal Reserve does it, how do they do it? The only way to do it is for the Federal Reserve to print money electronically so they can pay the Treasury either directly or indirectly. It'll probably be done indirectly. So the Treasury will sell the bonds to Goldman Sachs, for example, and Goldman Sachs will sell the bonds to the Federal Reserve. That's kind of the way they tend to do these things. But the end result is the Federal Reserve would have to print money to do that. That's called quantitative easing. It's a situation we had in the 2008 global financial crisis. We had it again in the COVID pandemic. And then more recently, they moved from quantitative easing to quantitative tightening, which is when they try to reverse what they've done with very, very little success. They've reversed it ever so slightly. But, if the push comes to a shove and interest rates are spiraling out of control, there will be no choice, because there's no way even now, the government can continue to borrow ad infinitum at today's interest rates. Any higher will just bring the end that much closer to the situation where nobody trusts the currency at all. So, at some level of interest rates, I'm going to say 5.5 or 6 maybe interest rate, I think the Federal Reserve will step in. I think they'll be buying a lot of bonds. When that will happen, we don't know, but I'll just point out that at the moment in the United States there's a debt ceiling which came into force on the 3rd of January or 2nd of January this year. In other words, the USA has not been allowed by their own laws to increase the debt. So how have they been paying the bills? Well, they've been running down their cash balance at the Treasury, and they have been suspended payments into the government pension plans, which at some point they will make whole. They'll make them whole as and when the debt ceiling is raised again. So these are called emergency measures. So they're on the emergency measures now. According to everything I read, those emergency measures will run out in late July or early August. So they have to raise the debt ceiling by then, or there's a possibility that they will default on somebody. Well, there's a certainty they'll default on somebody. We're not sure who it'll be, whether it'll be the government employees who don't get paid, or whether it'll be the Treasury holders who don't get their bond interest paid. But that's not likely to happen. They're likely to raise the debt ceiling. But when they raise the debt ceiling, they'll have to, at very, very short notice, borrow probably $1 trillion or more. And who's going to buy that? There's not a lot of buyers around. I mean, I know it's a very liquid market, but I don't think there's a lot of buyers around for $1 trillion now, given that one of the major holders of US Treasuries is Japan, and another one is China. Japan's got its own troubles. If they dared, I don't think they dare, but if they dared to, they would be selling their treasuries to buy JGBs, because the JGB interest rate on the 30-year bond and the 20-year bond and the 10-year bond are already spiraling out of control in Japanese terms. The rate of interest has gone from 0.1% to nearly 3% now, which is causing a huge headache for Japan, which has one of the highest debt to GDP ratios in the world. So to solve that problem, what they should be doing, but they probably don't quite dare, is selling their US treasuries to buy JGBs to stop those Japanese rates from flying. But they don't dare to do that because of their strong alliance with America and the defense and everything else. But what it does mean is they're not going to be there as buyers, because they can't suddenly start selling more Japanese government bonds, pushing the rates higher just to buy American bonds. That won't happen. So Japan won't be there. I don't see China being there. China has been already reducing exposure to the US Treasury market itself in favor of gold. So Treasury exposure is not going up, it's going down, and gold exposure is going up. So I don't see China as being in the market. And given all the jitters we've had and the uncertainties we have about the United States, and also the recent comments, was it by, who was it? Was it Larry Fink, who was saying, we're going to have a big problem with, what did he say? Let's just check, what did he say? I've got the words written down here. No, it wasn't Larry Fink, it was Jamie Dimon. He gave a stark warning a couple of days ago on bonds. He said, America's facing a worsening fiscal situation. It's a big deal. It's a real problem. Bond markets are going to have a tough time. Something along those lines. Now, these are really big boys who have got the inside track of what's happening. So who's going to be in there buying this $1 trillion of bonds come late July or early August? And I think gold is very well supported, and I think there's a real chance it might go into some sort of melt-up where the price increases very rapidly. What we've seen so far doesn't look like a very large rise to me, based on historical periods when it rose. If we take the period from 2000 to about 2012 or thereabouts, gold rose something like 300-400%. Stock market in the same period went down by about 12%. The S&P 500. If we map the rise we've seen so far in percentage terms back onto that period, we can see we're right at the very beginning of what could be of an extremely sustained rise, taking gold to several multiples of where it is now. And it could do that very easily. But I'm not trying to say when it gets there, it stops. There's no reason to think that it should stop at all. The only thing which can stop it would be some sort of fiscal prudence to such an extent that the national debt stops expanding, or at least expands at a slower rate than GDP. And there's no signs of that happening. Indeed, long before Mr. Trump's big, beautiful bill, the tax bill of this week, the Congressional Budget Office was forecasting that the debt to GDP ratio would keep rising ad infinitum, and they had it going all the way out for another 30 or 40 years, just going up and up, i.e. the debt was going to increase much faster than GDP was going to increase for like 30 or 40 years. Beyond that, they don't have a number. But they did say that that forecast is without the renewal of the tax breaks, because those tax breaks were supposed to come to an end at the end of this year, and they're not, and subject to this bill going through the Senate, it's not going to do so. So they have produced a secondary forecast saying, well, just in case those tax breaks are extended, here's another scenario. And if you look at the second scenario, it's much worse than the first scenario because the debt to GDP ratio rises that much faster. Of course, they've done a projection assuming that can continue, but there's no way it can continue because the things will spiral out of control long before we get to the projection limit of 30, 40 years.